Welcome to the Minds Capital Podcast, the show devoted to the growing world of independent sponsors and entrepreneurial private equity. My name is Will Smith, and I'm here with my partners in Minds Capital, Nicholas James and Max Lummis. Today's conversation is with Christian Seale of Despierta. Nicholas, what was the takeaway you had from our conversation with Christian?
Well, first of all, I thought it was fun how he made a word out of tropicalizing a concept. So you could take a US-based concept and take it to Mexico, and that is officially tropicalizing a concept. So that was fun, a new word for my ever-growing English vocabulary. The other thing that was interesting throughout this conversation was Christian has deep roots in the venture capital world, and he was able to kind of contrast the deal-by-deal space on the private equity side with venture capital and how growth equity kind of sits right in between the two. And so a couple of things that he said was one thing he did not like about venture capital was how it normalizes losing money, which we all know when you think about it. I just hadn't heard it phrased that way. And he was therefore compelled by the more stringent underwriting standards and also lower risk profile of private equity. Another concept that came up when he talked about venture capital is how the very, very large firms, Andreessen Horowitz and Kleiner Perkins and Sequoia, they have become multi-billion-dollar funds. And in order to generate deal flow for like billion-dollar opportunities to deploy capital, they throw money in the early stages. And so they effectively crowd out the smaller players or people who focus only on early stage deals, because for Sequoia, doing a $2 million seed ticket is just an entry ticket. And if they do a lot of them, that ensures they have pro rata rights for deals down the line. And so we talked a little bit, and I asked Christian's advice on how this potentially mirrors Minds Capital. And that was quite insightful for me, in that we are a gap equity provider, and we do a fairly high volume of deals. And we do them as standalone investments because we believe they will generate attractive returns as you take a founder-led, pretty unsophisticated business out of the lower middle market and into more middle market size range. But he pointed out also for those deals that may have a longer lifetime, that entry ticket could also become our pro rata opportunity to deploy a lot more capital into big successful platforms if they are held for a longer time. And so I think that could potentially become part of our broader strategy as we evolve our concept of Minds Capital. So thank you to Christian for doing that little brainstorming within this recording.
I left that segment with Christian thinking about, since we're small relative to some of the larger players, the family offices, the institutional capital that invest in the deals that we do, how do we protect ourselves against that? And I think that we benefit from a dynamic that don't know VC very well, but get the impression doesn't exist in VC land like it does here, where as we've learned, and in fact, our value proposition is that the independent sponsors who raise for their acquisitions are often struggle to raise kind of the gap. After they get their first anchor or two, there's a gap left over that they then have to invest an undue amount of time filling. And so that's exactly where we play. And so we solve a problem for them, even though we're not big guys and we're actually in deals where there are big guys. The crowding out effect maybe doesn't happen as much here. I can't say why that is, but I have the impression that a venture in VC land, they might just take the entire ticket. There's no opening there for a smaller firm to make an investment into a kind of a desirable deal. Max, what did you think of our conversation with Christian?
So it's not often that we get to talk about venture capital at Minds Capital. So that was a fun discussion, and I enjoyed hearing Christian's take on that. But I also enjoyed hearing Christian talk about what areas of healthcare he's currently investing in. And we do see a lot of healthcare deals come across our desk lately at Minds Capital. I'm very reluctant, quite frankly, to invest in a physician's practice. So it was really informative for me to hear why Christian likes some of these practices. I also wasn't aware that in Florida, that private equity can invest directly in healthcare. In many of the states, they have to invest through a management service organization. So basically, you're splitting up these healthcare practices with the doctors controlling sort of the professional organization, and then the private equity groups controlling the administrative organization. So to me, that's just kind of convoluted in some ways. I know it works and it can be done, but I've never fully understood that. But in Florida, apparently you don't have to have that structure, so you can make a direct investment, which is a lot cleaner. It sounds like there's still some opportunity in physicians' practices, particularly in Florida and other states where these MSO structures aren't required. So that gets my attention. That helps me certainly for the next time we look at a healthcare practice at Minds Capital.
Great. Thank you, guys. Before we get to the interview, our reminder that Minds Capital invests into independent sponsor-led acquisitions. Our check size is $1 to $3 million per investment. We average about a commitment per month. So if you're a sponsor raising equity for a platform acquisition, submit your deal to us at mindscapital.co. Or if you're interested in investing in Minds Capital as an LP, there's also a pre-registration form on our website for investors. So if you are accredited or can become accredited, fill that form out to be kept in the loop on future raises. Again, mindscapital.co. And here is the Minds Capital podcast interview with Christian Seale of Despierta. Enjoy. Welcome to the Minds Capital podcast, your connection to the growing world of independent sponsors and entrepreneurial private equity. We are your hosts, Will Smith and Nicholas James. Independent sponsors need a legal team that understands the model and knows the players. Platt Richmond, a Dallas-based boutique law firm, has deep experience in guiding independent sponsors through the complexities of their acquisitions. The team at Platt Richmond provides support on all aspects of your transaction, from structuring and diligence to financing and securities compliance. They also represent stakeholders throughout the ecosystem: capital providers, lenders, family offices, sellers, management teams, which gives them a unique 360-degree perspective on the sponsor model that ensures a seamless process for your transaction. Partner with Platt Richmond to focus on what you do best: finding and executing great deals. Visit plattrichmond.com today to learn more. That's Platt with 2 T's, Platt, Richmond.com. Miami-based Christian Seale is the founder of Despierta, operating as an independent sponsor that blends PE with VC and de novo creation to build healthcare enterprises. An HBS alumnus, Fulbright scholar, and global shaper at World Economic Forum, Christian previously launched a health tech VC fund that delivered a 5x return to investors, alongside co-founding successful clinical businesses. Today, they rely on the sourcing abilities honed in venture capital to find strong healthcare businesses and management teams that form the foundation for building great companies. Christian Seale, welcome to the Minds Capital podcast.
Thank you for having me.
Christian, we all know the differences between the independent sponsor model and VC venture capital. What are some of the similarities, the commonalities that you find there?
I think there's 3 ones that we found in our experience. The first is the ability to see the best deals and get in the best deals. And what I mean by that is if you're in venture capital, it's a game of exponential returns. And if you're in Uber, you made a fund many, many times over. And I think that's been our experience in the independent sponsor world. You need to see really good assets that are underwritable. The second is your ability to empathize with founders and owners. And so the same conversation that we're having with an owner that has had a business for 30 years and maybe is a little trepidatious of selling it is the same conversation you're going to have with an early stage founder, that is looking to partner with you. So those I think are, 2 commonalities for sure.
And then tell us a little bit about how it is that you arrived at a model or a career that blends these 2 models, VC and PE or independent sponsorship.
So I started at a Brown building a social enterprise called Equitable Origin, and really my first entrepreneurial endeavor. I would say made a lot of mistakes, but what that enabled me to do was know what not to do, and then be able to coach founders as I got a little older in my career around what not to do. I started also working for a VC firm, Mavron, which is Howard Schultz's consumer-focused VC. They didn't have a presence in Boston when I was at HBS, and really started to understand what the game of early-stage venture capital looked like. And this was in 2013. And I had a thesis around Miami just being a really interesting marketplace. In 2013, I thought it would become somewhat like a mini LA, if you will, or a mini New York, a capital of capital, the city of 2050, if you will. And that's definitely come to transpire. And what I did was I raised a small venture fund in 2015 to invest in early stage healthcare companies. So I have 28 companies in that portfolio. I've sold 10 of them. It's a good performing fund. But what I realized was those venture dollars to match long sales cycles didn't make a ton of sense. And so I said, well, let me try my hand at healthcare entrepreneurship. And so started 2 care delivery companies, one in the fertility world in Mexico, great business, and then another orthopedic business that I sold to private equity in 2022. I learned that I don't love being a CEO. I don't love, the operating. And so landed on this model, which did not know what independent sponsor was at the time, but this idea of venture building or company creation. And that was really the genesis of Despierta, and realized, being a solo GP is pretty tough. Being a solo entrepreneur is pretty tough as well. So I said I want some partners, and ended up partnering with 2 folks, of which I'd backed previously. Both had exited their businesses that I was investor in. One very, very successful repeat entrepreneur, and we launched Despierta, and we called ourselves at the time a company creation platform, and we create businesses by acquiring them, a la the independent sponsor model, and then de novo, which you would think of, a typical venture builder.
So you actually came to the independent sponsor model by way of company building. You just saw that for the reason that many people like buying an existing business that has real revenue and product market fit, that it can be a shortcut in a kind of a venture style fund context as well.
And it's very difficult in our experience to get the first $1 million of revenue. It's much easier to buy it. And I'd say that that's really where we landed. And so the same process that we go through around idea generation, writing a thesis, testing product market fit, you can do on the independent sponsor side. It seems to us that there are some cases where it makes more sense to buy an asset that is already producing and then build. And I would say we were pretty unique when we were talking about this in 2022 from what we could see. And now there's a lot more folks doing this. So like General Catalyst and Thrive, 2 very, very large venture capital funds, are funding a lot of companies that are buying an asset to start their strategy. I have a really good friend, Will Johnson, who came from Oscar, that just started a company called Guide AI, who's buying brokerages and then making them AI first. And so what you would think of as, your typical independent sponsor model, or private equity, venture starting to come in and say, we're okay using venture dollars to buy revenue or assets, because that maybe is a better mousetrap, if you will, than doing it all yourself.
Well, if I heard you correctly, and pairing that with what we see, it sounds like that phenomenon is specifically because of this perception of the AI opportunity, that basically there's this window of time where AI can be introduced to traditional businesses and transform them and gain all sorts of advantage. And so that is an interesting enough opportunity that it's interested even VC, who tends to like net new kind of ideation. So it has very much to do with this sort of AI first thesis, right?
I think that's exactly right. I mean, I'll give a really concrete example. There is a holding company that's funded by VC based down here in Miami, that is rolling up HOAs. And what they've found is that they can automate the board deck creation process that would take a team of, call it 3, 5, 6 people. And so you're taking a business that maybe was a 15 to 20% net margin business, and all of a sudden, you're maybe doing something 50, 60, 70% closer to the software or the AI margins that VC likes to see. And so I would say, yes, 100%, this is being driven by AI. And also, I think it's being driven by, at least in my world of healthcare, software and AI for a long time was thought to be the one that had outsized returns. But when you look at healthcare specifically, it's a people business, it's a service business. And so more folks are saying we need to go back to services because frankly, that's like what that business is. And so we're okay buying services businesses to layer on AI.
And going back to how you straddle the models or kind of have a IS within VC, one thing about VC, or at least our sort of the stereotypical picture of a Silicon Valley business, is that it has to experiment a lot before it finds its product market fit or its optimal offering. Do you find that the businesses that you look at buying, you intend to experiment with, or is it more of a private equity approach where it's do more as long as this business continues doing what it's already doing, will be okay? And maybe there are some levers we can pull to generate even more interesting returns or business lines. But the private equity generally wants to see that the formula that's gotten the business to where it is can continue on and be enough to generate a handsome return. How do you see all that?
I would say it's yes and what I mean by that is the same process of idea generation we really take up front, and so spend a lot of time thinking about thesis, asset pipeline, talking to downstream capital, making sure that they like what the strategy is. And so I would say that that's very similar to how we think about venture creation. In our world of healthcare, it's just such low hanging fruit. We're acquiring clinics that are still on pen and paper. They don't have any type of EHR, which is an electronic health medical record. They never are using AI. They're not automating customer service. And so while our modus operandi, and when I say our, it's our CEOs who have done integration acquisitions over and over again, is to keep everything that is going right. And in this moment where we have access to technology, stuff that we've created ourselves and or stuff that we're investors in or stuff that we just know in the market, it is really important to integrate that. And we hope to have a improvement in margin, but it might just be that our healthcare providers are happier because they have less admin that they have to do at the end of the day. And that means that they're able to serve their patients. I mean, one of our assets here in South Florida that we bought, we were the fourth percentile for a health plan, meaning like we were as bad as you can get when we took it over in October. We're now the 72nd percentile. And I think some of that has to do with some of the technological changes that were implemented because we made our providers a lot happier. And that entailed and labeled them to have more time to spend with their patients. And then their patients were able to report higher satisfaction scores to the health plan.
That sounds like a fantastic case study. Can we hear more? Can you tell us about that investment from the outset and let's get into it a little bit?
Sure. So I had a thesis in healthcare generally in 2015 when people in San Francisco were building, Fitbits for the mom that already had 5, that was kind of missing the point, that we should be investing in Medicaid, which are poorer people, and Medicare, which are older people. And I thought Miami was just this really interesting market to do that. And so what that netted is a lot of my early stage investments were investing in Medicaid focused businesses. And so I started to learn that Medicaid is very scary for folks because the reimbursement costs are lower than what they are for Medicare. It's a whole political issue that we don't need to get into, but I'm pretty passionate about. And I just thought there was a ton of opportunity. And so to come full circle, Mangrove is a business that we launched here in South Florida to focus on lower income families, which means that we're contracted to serve primary care for lower income and Medicaid and ACA being Obamacare. And a big part of that thesis was the prices for these assets that sometimes were trading at 4 to 5 times revenue, 15 to 20 times EBITDA, we see for 3 to 4 times. And so you had your typical private equity, just multiple potential to expand, but then also no one had really looked at serving this patient population before. And what we know from our experience is that if you serve them on a preventative basis and they don't go to the emergency room, as an example, for a common cold, that you can save a lot of money for the system, and therefore you can make a lot of money as a provider that is at risk. So we canvassed the market for about 2 years, got to know it very, very well. Prices continued to come down, which was great. We found an amazing operating team, a woman woman who was born here, went to Harvard undergrad, went to Wharton for healthcare, worked at one of the leading value-based care entities called ChenMed, launched a General Atlantic-backed senior care business in Arizona. We were lucky enough to get her CEO. She'd done 30 acquisitions in this market, so knows it like the back of her hand. We found a CMO who arguably is the leader in population health, who also works with us at the Despierta level. So just found this amazing management team. And then we found a small asset, the one that I was referencing before, that was not owned by a physician. And that's a really important point because a lot of times in our experience with some other assets, when a physician's the owner, it can get a little bit more complicated. And so it's a part of our strategy to look for assets that aren't owned by physicians, which is something you can do in Florida. So long story short, we acquired that. We're acquiring another one. We're off to the races. The morale is incredible. The health plans are calling us up and giving us patients, which is amazing because that is a way for organic growth that we hadn't underwrote for.
And Christian, this is a GP?
Yeah, so general practitioner or primary care. And in this case, a big part of the strategy is just to move to risk, which means that we're responsible for every healthcare dollar of our patient. And the reason for that is we think that we could care for them in a way that they haven't been cared for before and do it on a profitable basis.
And then, so say more about the moving the business in such short order from the 4th percentile to the 70-somethingth percentile, and how technology or AI played a role there.
So I think first it was bringing in people that really cared. So Elena, our CEO, and Dr. Maxon, our CMO, like just really, really are like passionate about this. And so they went in there and, gave an amazing speech and said, this is what we're going to do. And if you want to stay on, great. If you don't, all good. So I think just like morale boost was one. 2, upgrading the clinic, like little stuff, like small investments and making it look and feel and, having pride. A renaming Mangrove from something that, just was not a good name. So there's like real camaraderie. And then yes, the technological. So we use an EHR called Elation. That's a newer EHR. We have no interest in it, but it does a lot of the things that the providers want. So it just makes their job a lot easier. Simple stuff like we weren't on the provider directory, which means health plans will put the providers that you have access to under their health plan. Our clinic wasn't even on it. So like being able to do that is something easy that therefore you can get called. And so you get more patients. So the person who's responsible for growth, that's just an easy mechanism for them. So I would say bringing the private equity discipline that Elena has and the experience too was very refreshing for the team. And then obviously we've hired some new people as well that have been really, really important to the success.
Newly acquired and PE-owned companies are high-value targets. Hackers time their attacks when teams are distracted by the deal, exactly when a breach can stall operations, bleed cash, and blow the thesis. Inzo Technologies is your full-service IT MSP for post-close stability. They assess your target, surface the biggest risks in plain English, and give you a day 1 through 30 plan to cut exposure, prevent downtime, and even find cost takeouts like bloated telecom bills. Check out inzotechnologies.com, INZO, or email CEO Nick Akers directly at nick@inzotechnologies.com. Having acquired Inzo himself, Nick understands the challenges sponsors and searchers face when transitioning a business. So make sure to tell him you're an independent sponsor and listener of the Minds Capital podcast. nick@inzotechnologies.com.
And 2 other questions just on the leadership here. First, it's maybe a little bit in the weeds, but I'm curious. The business was owned by a non-MD before, and that's a Florida idiosyncrasy where that's not typical. Just what was the situation there?
So there's something called the corporate practice of medicine, which is non-physician owners in certain states are able to own assets. And so in Florida, you do not have a corporate practice of medicine, meaning non-physician owners are able to own assets. And what that means sometimes is you might have an owner that is just relatively absent. So, they're not making the investments in the infrastructure. Maybe they aren't treating the employees super well. Whereas in a corporate practice of medicine state where a physician has to own or some type of MSO structure, physicians there probably some of the time, I mean, maybe not all the time, but they're a little bit more hands-on. And so I think at least in this case, because the owners weren't physicians, and because they were pretty absent, that ended up not playing in the favor of the asset before we purchased it, but playing in our favor post.
Yeah. And so the previous owners had been entrepreneurs who'd founded it, or they had been buyer. Okay, interesting.
And that's pretty common here in South Florida. Excuse me. Just a lot of entrepreneurial activity around this space, and so you have a lot of non-physician owners who have built some pretty big businesses.
And then, just curious, what was your pitch to bring on Elena? I think you said her name was. It sounds like she was very accomplished already, and that this would have been a risky job to take. This sounds like a pretty small business that you acquired. So I'm just curious how you were able to recruit her.
I've known Elena for 10 years. And so I think it's the progression of, I came down here, said I was going to do something in healthcare, execute on it. We've executed on some other great opportunities and assets. And then I think the vision. So, we bought one clinic, we're buying a second, we're buying a third. We want to be the preeminent provider for low to moderate income families. And Elena wants to be the head of that.
Some investors, including within the healthcare sector, shy away from clinics. Why is that? And why are you taking a contrary position to that?
It's a great question. And we like clinics because you can control things. And what I mean by that is you can control what the EHR is. You can control the AI tool that maybe is automating on the back end. You can control the way that you interact with your staff. And so a lot of folks, I think, frankly, got burned by buying clinics at really, really high prices. The 20 to 25 EBITDA or the 4 to 5 times revenue that we were speaking about. And so I think that the investor chatter that you hear today, that they want to go away from provider focused businesses, is a lot of that. And if you're buying at 3 or 4 or 5 times, we really believe that this is an amazing opportunity. And I think there's some people that agree with us. And it's just hard too. I mean, these are service businesses dealing with something super intimate, which is health.
You mentioned also that the physician owner element, which is more prevalent perhaps in other states, is complicated. And by that, I take it you mean the key people risk that you often see in clinics, right? That there are only 1 or 3 or 4 providers or GPs or MDs, and the seller is one of them. And so there is that transition risk and key people risk that a lot of private equity buyers in the lower middle market have to face if they're buying a clinic.
I think that is spot on. And then there's some unintended consequences or things that are hard to underwrite for. It's a physician owned and the wife or the daughter has been very involved, but they're not on payroll, so you can't see it. And they come in on a Saturday and maybe talk to the staff, and they don't like the new technology. And so there's some things that it just, when physician or family owned, and I'm sure this happens in other industries, I can only speak to our experience, that makes it a little bit more complicated, which is very different than the absent owners who are owning through a shell, it's a very different dynamic. In some ways, a cleaner transaction.
Are there some type of clinics you would say are safer or better for investing than others, such as, pediatric clinics or specialty clinics or whatever it would be? Can you kind of divide good, bad, ugly?
Sure. So we're big believers in primary care because it is one of the best ways to save money for the system, and you can do a lot, and the primary care is the quarterback. And so we think that those are really good businesses. Some people would agree with us. You saw a massive just acquiring of primary care clinics from private equity, from strategics, from hospitals. That now has come down a little bit. Our view is it's going to come back. Specialty is all in vogue now, and specialty being very, very expensive. So oncology, as an example, or neurological, whether it's dementia or Parkinson's, things that are very, very high ticket items, and specialty drug and compounding pharmacies. I would say that that is where a lot of money has been going and probably continues to go. I personally like to buy things at low prices because you have a lot more headroom. And so we stay away from those right now just because they're pretty pricey.
And then, of course, you opened your own clinic in Mexico, you talked about, right, with the fertility clinic. Can you tell us a little bit more about that venture? You started it from scratch, is that correct? As a side gig to the VC fund you were operating?
Yeah. So it was in 2020. Two classmates of Brown, one of which I'd started Equitable Origin with, the certification in Latin America, called me up and said, we're having a really hard time finding good fertility care down here. We've gone to 4 different folks, and we ended up doing our care up in the States. We think there's this massive opportunity to create just a much better brand and much better service. And I'd had the experience of building the concierge orthopedic clinic already and investing in a variety of women's health companies, and just absolutely love the opportunity. The tailwinds were incredible. Mexico's massive population becoming a lot more secular. Folks were postponing having children. More women were entering the workforce. The phenomenon that happens in the US where corporates would pay for fertility services had not happened yet in Mexico. And then there was really no brand. And so I thought it was an absolute no-brainer. And frankly, probably gave me the confidence to do Despierta in that we placed the capital, meaning myself and some of my investors and my 2 partners, and then we hired a CEO, very much similar to the model that we've done at Despierta. So we launched in COVID of all times in 2020 in Mexico City. We have 2 more locations. The business is growing super well. We're acquiring a hospital now so we can go downstream to do births and then do also other women's health related procedures. We're getting into male fertility because we're learning that the male fertility has a lot of, or infertility has a lot of issues as it pertains to being able to have a family. And so our intention is to build a very big women's health brand in Mexico and then see if it makes sense to copy and paste that in other markets.
So as a company builder, did you raise capital at the front end of that? And have you run it as a startup with venture money?
Yeah, so we put $2 million in to get the first clinic off the ground and then raised money from Lux Capital, which is a San Francisco-based VC, pretty well known. It was their first investment, I want to say, in Mexico. And then a few others, Ignia, which is based in Mexico as well. We've got a very strong balance sheet and now, given the profitability, able to go out and buy some assets. We might do a growth round later to help fuel some of the M&A. The first 3 have been de novo clinics.
And this opportunity to Lux was perceived as a potential hockey stick. I mean, this could be kind of venture style returns. At least that was their implied bet.
Yeah, I would say when you looked at the fertility market in the US and what's happened, and then even some markets like Israel and Spain, you had clinics trading at 15 to 25 times EBITDA, and then you had some pretty big names. Progeny is a publicly traded fertility benefits business, Maven in the space, Carrot, these kind of hockey sticks, to use your word, unicorns. And so I think the bet for them was Mexico is a very big market. It is having a lot of influx from other places, particularly the digital nomads, building a large woman health brand on a risk reward basis is probably a good bet when you don't know the market and there's some downside protection associated with owning clinics and having patients and having a real tangible type of business.
Mm-hmm. Mm-hmm. And I think I heard you say that you placed a CEO into that business, which is of course the format of private equity, but far less done in venture capital. I mean, it's always kind of founder-led businesses, at least for a while. So you were kind of blending the 2 models, it feels like, with that particular move of bringing in a CEO. Can you respond to that?
Very much so. And it's really what led me to have some confidence that we could do the model at Despierta. And what we found when we were talking to investors was the business isn't net new. To use some words that you talked about at the beginning, this is like fertility is known. It's just this is geographic arbitrage. We're taking something that's already been proven in other markets. We're going to copy and paste some of it. We're going to tropicalize it or Mexicanize it, if you will, for the market. And because we have the benefit of investor dollars for the past 20 years into this space, we can learn from some of the best and the worst. And so do you really need to have a founder that is, this amazing Steve Jobs type, or you just need someone that executes extremely, extremely well on a playbook that frankly is pretty proven?
You talk about tropicalizing the geographic arbitrage of Mexico. If you look more broadly, how is Mexico as a place to be an independent sponsor and do M&A?
I wouldn't classify the Mexican business as an independent sponsor. It's very much a venture-backed business. And so I can't speak super directly to what it is to raise capital as an independent sponsor in Mexico. What I can speak to is assets, and there are not a lot of folks in our market that are looking to do M&A, which is great. So it's not as competitive. I've heard, because I do some things in Spain, and I'm involved in some search related activities there, and I've talked to some people that do it in Mexico, that Mexico is becoming extremely hot from a search and potentially an independent sponsor. I don't know if they use that nomenclature down there, but I think folks are realizing that it's worked so well here in the US, let's go ahead and do it other places.
And so if we look at the arch of your career since HBS, right, you raised a VC fund, and that you invested into 28 portcos, but it also spawned you to start businesses from scratch, such as this one in Mexico. And then within that fertility clinic, you eventually started doing some M&A. Through having that whole venture, you got familiarity with the SPV structure. You got familiarity with having operating partners or management teams on the ground that were hired guns. And then also you recognized, I think, from your venture experience that it's faster, as you said, to buy than build the first million of revenue. And are these the ingredients that fell into place for you to become an independent sponsor, which is effectively how you characterize yourself now? Or was it really the macro picture, where we see now the VC space in general, since COVID has become relatively less attractive, that pushed you towards more of the PE mature buyout space?
I think all of it. We just love company creation. And so company creation, either de novo, like the business in Mexico or some of our AI businesses, or through the independent sponsor route, which is acquiring. And I would say being flexible in that thinking was really, really important. And some people just don't get it. They say, I don't understand how you have a vehicle that has committed capital that has this barbell strategy. Like, are you VC or are you private equity or independent sponsor? And I just say, well, we literally build businesses through acquisition or through de novo. And some people get it, some people don't. And I've, that's just part of it. But the thing I think that was really, really insightful for me was working with downstream private equity firms and thinking and learning about how they thought about businesses and how they underwrote businesses, and then taking that to the venture capital world. Because I think in my experience and seeing some of my peers, and you kind of see it sometimes, I mean, this is an exponential law game in VC, but it is also maybe not as stringent in terms of the underwriting profile. And so taking some of what we learned from our private equity partners and then put into our idea generation has been really, really helpful for us.
So talk more about that, being a private equity operator as a fertile hunting ground for spawning new business ideas.
So let's take a primary care business that has to summarize its patients' medical records. That takes a lot of time. It means that you're paying people, and it is a problem that exists. Now, if we have a great entrepreneur that's summarized medical records for a really long time and is building a business in that space, it's such a great match where even if they're not building the exact product or they're not a customer, they can at least talk to the CMO or the providers or, hey, give me this, tell me. Because one of the things that I've found in early stage venture is access to customers, not just from paying the bills, but like, what do you like? And so if you have access to a petri dish, which is a clinic or clinics where you can go in and talk to providers about what are their need sets, it's just like, that is gold. Frankly, that might be better than a VC dollar and might be better than your first contract because it's helping you design your product in a way, and it's access that, frankly, a lot of entrepreneurs don't have.
And, you know, coming from your background, what was it about private equity underwriting that surprised you or really disciplined you that you apply as a business person today?
In venture, and this has just been my experience, losing money is normalized. In private equity, it is not. And I worked at Goldman, I went to HBS, I was trained in a certain way that you are not supposed to lose money. I think 10 years in VC, again, it is normalized that you're supposed to lose money. So it's very refreshing when you sit in a boardroom and these people will not lose money, full stop.
I'm reminded, Nicholas, of I can't remember which guest, but talking about having a zero in private equity is sort of inexcusable because you're not, unlike venture where you're starting from zero. And so the idea might just not take, and you do lose the investment. In private equity, you already have an EBITDA generating asset. So if the investment goes completely to zero, it doesn't only mean that the thesis didn't work, but you destroyed value.
And I think it's especially relevant in our case at Despierta because we have limited shots on goal. We have 6 assets in our first holding company. Our second holding company will probably be something similar. And so our loss ratio cannot be what the loss ratio is of VC. And we would like to think that if we're taking the disciplined underwriting approach that PE has to company building, therefore our loss ratio should be less as well.
But isn't it also just a matter of where on the risk reward spectrum you're comfortable being? Because in VC, famously, you know, you're looking for the one asset that carries the whole fund, and that's just not how private equity is. You're farther in on the risk reward spectrum. The returns are also not going to be as spectacular, but it's safer, a higher chance of preserving capital.
I think that's exactly right. And I think about portfolio construction. And so in our portfolio, we have 2 independent sponsor deals that look and feel a lot more like private equity type of returns. And then we have 4 that we're swinging for the fences. One is 100x right now. And so I want both in what we're doing. I don't really love the idea of only swinging for the fences and potentially getting zeros.
Christian, you had said how the barbell strategy that you have can be, some people just don't get it, won't get it. But let's explore that for a minute, specifically with respect to your own capital providers and raising money. You'd think that, I assume maybe that's who you were talking about, that some capital providers want to see a clean, conventional, single mandate. You know, you do this sort of investing, and the fact that you have this, that you're blending these two investing models. You might have bumped up against most resistance in the capital provider among your LPs. Is that a correct assumption? And talk about capital raising when you're bringing an investment opportunity that kind of blends these 2 very different styles of investing.
So when we went out in 2022, we didn't even know the word independent sponsor. So we knew a little bit of these company creation platforms, and there's some out there, some call themselves venture studios. And we learned pretty quickly that when you talk to big capital allocators, you think pension funds, endowments, folks that are supposed to put a portion to VC, they did not understand this model as it pertains to VC. A lot of them also, at least in 2022, weren't necessarily investing in independent sponsor deals. It's been amazing for me, at least over the past 4 years, how much this category has become, one that, and to the work that you all are doing, something that people will look at, McGuire Woods and some others, obviously. So we had a really hard time defining ourselves. Now our vehicle's marked above 10x. We've given some DPI back. Like, it just makes our lives a lot easier, where they're like, I don't know if I get it, but you guys seem to have a formula that's working. And so like, don't change it too much. What have you learned? What are the 3 course corrections you're going to make? And those are the conversations I'm having now. Whereas before it was just this education process for sales cycles of capital raising, as you guys know, can be long. And then they're like, well, I'm not going to do it. But like, you took 3 months, 6 months to educate them on this whole model.
On the venture side of the house, or the VC side of the house, Christian, tell us about your Subquadratic investment, please.
So we invested in Subquadratic in December of 2024, and we got a very, very nice position at a pretty low basis. It recently priced at $500 million, so we're marked around 100x. Those are paper gains, but in a very short time frame. We're really excited. They did a announcement on Twitter on May 5th, just talking about what they're doing, and I'll explain that in a second. And they had 70,000 inbound signups, some really, really large enterprise accounts. So we're super excited about what the prospects of the business hold, and right now are talking to every single one of those 70,000 folks, but prioritizing those that can be large enterprise clients for us. And the problem that they're solving is this idea of token tax. And so if you use ChatGPT or Claude, you might have run into the fact that it says, hey, you can't do this anymore because you've used up all your tokens. That's on an individual basis. On an enterprise basis, CFOs are now coming out and publicly saying, I have blown through my token budget that I was given at the board level. And so Subquadratic is building a subquadratic model and architecture that means that tokens cost scale linearly and not quadratically. So if they're able to do that, they take the cost of using these tools, which we're all using, and our bet is, we'll just continue to use, down significantly. So that's extremely exciting. And I think that's why the market's pricing it the way it's pricing. It has been big learning for me personally, as someone that feels like they know what they're doing in healthcare, to get smart really quickly. I didn't even know what the word subquadratic meant before, to go ahead and learn about everything that's happening in GPU and compute. And this market moves so quickly.
A business whose value prop is essentially bringing down the cost of AI, a cost that is today kind of driving the S&P 500 and one of the key macro trends in the world. We were just talking about it earlier. That's quite a value prop. How were you able to spot that, and how were you able to get access to the deal?
The same thing that we were talking about at the outset, your ability to see the best deals and get access to the best deals. And so one of the co-founders is a 1000x engineer. And when you've had successful exits or been around successful business owners and founders, you can just tell, that someone's really, really special. And so this individual, Alex, I think really did this out of necessity. He did not have the balance sheet that an OpenAI or an Anthropic did. And so he had to take 10, 15 years of generative AI research, which he'd been a leader on, and start to implement some of these theories and have different innovations at every single level across the value chain that now compound and have brought us to where we are.
Was there some Miami connection for this business?
So we met Alex and another of his co-founder who's no longer there through a Miami connection. And then part of our model at Despierta is to place the CEO. And so one of my partners has been the CEO for the past, basically since we made the investment.
How does the term growth equity fit into your model?
Growth equity would fit in when we think about the folks that we partner with on the independent sponsor platform. So the two that we have done to date, we put in initial capital, we source teams, we source the assets, and then we've worked with downstream capital that's private equity generally, but you could call it growth equity.
Yeah, because I would imagine with the Mexico Fertility roll-up we talked about, and now with Subquadratic, you started them from scratch, or was more on the venture side. And so it really becomes a stage off kind of investing versus a change of control, recap, LBO style investing. And so that to me is eventually you reach the maturity level where we call it growth equity, right?
I think that's right. So, we will use growth equity and debt for the fertility business in Mexico to acquire, as opposed to go all de novo. And you're 100% right. That will be a minority investor. That won't be a majority investor.
And one of the reasons we don't see a lot of growth equity in the independent sponsor space, at least not yet, is because, well, first of all, it often happens without a change of control event, right? So you'll have an incumbent seller or founder who retains control, and that just doesn't perfectly jive with the private equity model. The other reason is that valuations tend to be high because these are extremely fast growing companies. And so your normal range of, 4 to 7x is going to be blown out of the water by the typical healthcare or software oriented growth deal where they're raising a lot of capital on a pre-post money valuation basis rather than an EBITDA multiple basis. And at Despierta, you guys really are across the spectrum, right? 40% VC and de novo, 40% more buyout or opportunities to buy established businesses, and 20% opportunistic. And so naturally, I would imagine growth equity, these kind of opportunities could exist on your spectrum as well.
Yeah, especially as the venture businesses mature. I think that those are definitely folks that we'll work with, and Subquadratic, will raise capital, we hope, at much higher prices. And so that might be defined as a growth equity round. And then another one of our AI businesses, which is really focused on clinical AI for your health, that was solving the problem we were talking about around medical records summarizations, is getting to a point where it could raise growth equity as well. So that's a very big part of this model, is having good relationships with downstream capital. And it's the same conversation you're having with capital providers in the independent sponsor world, which is, if I do these things, will you invest? And in this case, it's, if we launch this company with this CEO and get to this metric, will you be an investor of the Series A, the Series B, the Series C? And so knowing that before you launch has been really, really helpful for us.
It's been a trend for the last few years that my friends from HBS and people that I've known who's been in the VC world and tech world, increasingly I see them dabble with growth equity and then eventually with SPVs and independent sponsor deals and private equity. And I think part of it is probably, the relative attractiveness of the model, where independent sponsorship 10 years ago just wasn't known at all, as you mentioned earlier, and VC was all the rage at the time. But do you think, Christian, and just looking at the grace in your beard there, you must be the same middle-aged as me and Will, is there also a life stage element of this where, as we get older, there's an opportunity cost on your time, and having all your eggs in one basket with high risk ventures is just not as compelling any longer? Is that also part of why my network tends to be trending more in the same direction as you've been kind of moving?
I think that's right. And then I think it's, if you're just really honest about risk adjusted returns, and I would say the adjusted part is partly lifestyle. It's also partly just, do I want more gray hair unnecessarily, or have my HRV and my Aura ring, through the roof from, call it 8 a.m. to 6 p.m. Like, who needs the stress of venture sometimes, right? So I would completely agree. And one thing that's happening in VC, and I do believe that if you're really specialized and you're early, you can make a lot of money. But a lot of the chatter around GPs are, if you're not some of the big groups, Sequoia, Andreessen, and others, it's really, really hard, because what they have done and are continuing to do, and they're doing an amazing job, is they just buy the index. And so what I mean by that is, if I have a small fund and I'm investing in a company at a $10 million pre-money, Sequoia comes in and they can pay 100. They don't really care because it's just an option call for them. But for me, that's pretty meaningful. And that dynamic has so many compounding effects that we could talk about for hours, that makes it very, very hard as a smaller vehicle, particularly generalist in my humble opinion, to have outsized returns. And so the folks that were starting funds out of HBS, if they haven't got to that level, or those shops, I think, are realizing, hey, 4 to 7x, pretty good here. And then
that's an interesting observation. So you're saying Sequoia and Kleiner Perkins, they can go way overboard on the valuation with seed investing in early stage, because For them, the big ticket is downstream when they're going to invest, 200 million in a deal that is performing. And so overpaying by 2x when the deal is worth, 2 to 5 million is, who cares? If it gives us the call option that one of these gets to the stage where we are in prime position to put in 200 million more. Is that how it works?
Very much so. And I've had that experience, unfortunately, many, many times. And I would argue I should have paid the 200 million or whatever the price was, because OpenAI, I saw at 20 billion and now it's almost $1 trillion. So that was a 50x. So, I mean, I can argue both sides of the coin, but it's really tough when it's not OpenAI and you did that 10 times and all your things, you overpaid and they went to zero. So yes, it's very much how it works. But the other phenomenon that's happened, at least when I graduated 2015, there weren't many billion-dollar venture funds. You had 200, 300, 400 million dollars. It was pretty big. The multi-billion-dollar venture funds have now been normalized. And so that's really, really hard to compete against.
Because of this dynamic that if you're an early stage investor and you have 20 million fund, yes, you can contribute in the seed stage, but you can't help them downstream. And so you're competing against people who are across the whole spectrum from seed to growth equity. And a founder would rather go with them.
Yeah, maybe monopolistic in nature. It's like if that's one example, but if I know I need 400, 500 million dollars in capital, why would I go work with a small group when I'm just gonna have to go out and raise again? If I have a $5 billion fund behind me that says if I hit these milestones, they'll give me the 500, then you just can't compete there. So there's just a lot. And then if you have a $5 billion fund, you're getting 2% management fee on that. That's a lot of fee income. And so you can hire the head of platform, the head of BD, the head of data science. And so you have all these resources around you that can help your portfolio companies. That me, as someone that has a $100 million fund, sure, $2 million of fee income, that's good fee income, but I can't compete on the resources that I can give my portfolio companies.
So going a little off script here, Christian, if I may get your take on this. As you're talking, I'm thinking about how does this apply to Minds Capital? And Minds Capital, as you know, we're a pretty small fund, but we place $1 to $3 million of gap equity into independent sponsor-led acquisitions. And that's what we do. And we do it on a standalone basis. We do have a little bit reserved for add-on acquisitions, but certainly not hundreds of millions. But how can we take the lessons that you were talking into the independent sponsor space if we were to apply it to Minds Capital? And how would that make us more competitive, do you think, if we could do both gap equity for smaller, true lower middle market deals, and on the back end support larger, very successful roll-ups that are scaling fast and where we've been in on the train since the beginning?
One thing that might be helpful to think about is going to larger capital allocators, the endowments, pension funds that we spoke about before, and say, will you give me a commitment or at least look at my deals downstream? And what I mean by that is you guys put in the 1 to 3 million, and then that you need another 20, let's say, in the future, but you have that capital lined up and you SPV it and you take, whatever the market carry would be. But one thing that I've learned from myself is particularly my first venture fund and in my first holding company, we're getting smarter about this, but the pro rata rights that we have are extremely, extremely valuable. And I don't need to have a committed fund vehicle to maximize those opportunities. I just need to make sure that I'm talking to enough downstream capital about what they want to invest in. And I'm seeing more from the family office world. I don't know as much about, the professional capital allocators, those endowments, pension funds. They want these SPVs. They want these independent sponsors. They don't want to be locked up in a fund for 10 years paying 2 and 20. And so you guys might have a real opportunity if you do have downstream capital needs to say, line up 5, 10 folks that you will go to every single time, and they commit X amount, and you get to take 10, 15, 20, 25% carry on top of that downstream capital.
Oh, thank you very much. Really valuable.
Christian, before we let you go, just tell us about one of your other very early investments, Theses, that you had, Miami itself. You beat the trend there. So everybody moved to Miami. They decamped from Silicon Valley to Miami in 2001 during COVID. But you were there 6 years earlier. So just fill us in on that whole decision.
Probably the best decision I've ever made in my life, and I'm super grateful. I'm looking out at the water right now, and I pinch myself because I've always wanted to live in the city, and I love this city. I'm super grateful to be here. And I would say when someone told me I was committing career suicide at HBS, I was like, I gotta go, because there's those sayings around, you're either crazy or you're right, and I had been coming here since 2009, and there's just something about the vibrancy of this city that I didn't think it would ever become what it has become, actually. But if I was 20% right or 30% right, and I think the other thing that was really interesting, and I don't think I fully appreciated this until I started living here, if I had tried to do what I had done in Boston or New York, I would have got the door shut on my face. I mean, I was on the stage with the mayor talking about innovation or getting walked into the CEO of a health system because nobody was coming down here and trying to build an entrepreneurial ecosystem. And so to the point of geographic arbitrage, I don't know if I'm actually better than anybody else. I'm just willing to take a little bit more risk and go really, really early. And so for me, it was like I was able to be a growing fish in the tiniest pond. Whereas if I'd gone anywhere else, I was another HBS grad who sure had some entrepreneurial experience and maybe smart, et cetera. But like it was just too competitive.
And so what does it look like now, 10, 11 years later? As I said, we've heard a lot of capital has moved in.
I used to feel like I knew everyone in my world, and I can't even say that I know 10% of the folks in the finance world at this point. Ken Griffin's name is over a lot of buildings. Citadel is down here, which I think is really made this place professionally acceptable. And I have more and more people, hey, I'm thinking about moving to Miami. It feels like it's the first inning. I feel like it's like the 6th, 7th, 8th inning. But so when I hear that, it's like this place has a lot of room. You do have some issues around infrastructure, and I hope we continue to get more water taxis and we figure out some traffic things. Yet it is exciting to be part of a city that seems like it wants to grow, seems like it wants to listen to some of the mistakes that some other cities have made. And so, yeah, I love it, and I'm super grateful to be here.
Great note to end on. Christian, we hope that you'll keep Minds Capital in mind for next time you have an independent sponsor related deal. We'd probably look at a venture deal, but it's outside of our own mandate, so less likely. But for your independent sponsor style deals, we'd love to take a look. And we thank you for coming on the podcast.
Well, thank you for having me, and thank you for all the work you're doing.
Thanks, Christian. Hope you enjoyed that interview. For more like it, subscribe to the Minds Capital podcast wherever you listen to podcasts. You can also watch us on YouTube. Also check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. We invest equity in independent sponsored deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about future fundraisers. See you in the next episode.